Welcome to No Fluff, Just Ideas. This is your host, Sophocles, and we're going to be discussing investment ideas from around the world. So buckle up and enjoy. This podcast is for educational purposes only. Full disclaimer at the end of the podcast.
So today I have with me Robert Leitz of iolite Capital, Switzerland. I've known Robert for some years now. We first met at ValueX Clusters, an event run by Guy Spear, and getting to know Robert, his character, and the type of ideas he invests in, I really wanted to bring him to my event in Cyprus, which he came to in September. I'm very happy about that. He's a very candid investor with a lot of interesting deep value ideas. This particular stock had some recent news, and so I reached out to Robert, and he graciously accepted to do a podcast about this opportunity. By the way, just a small note here, I do have my next in-person event in Vietnam in March. So if you want to check that out, just go to fatalphavalue.com and you can find all the events there. There's also a link in the notes. So welcome, Robert. Thank you for appearing here.
Well, thanks for having me.
So why don't you tell us about the name of the company, the ticker, so that people can start Googling it while they're listening, and tell us about what this company does.
Sure. So the company is called MTY Food Group. It's listed in Toronto, and the ticker is MTY. The company is based in Montreal. As Sophocles said, I presented this investment case at his conference in Cyprus in September, so just a few months back, as a great long-term investing. And we just received some news there. The company is up for sale, potentially, if they get a good price. And apparently, a few offers are on the table. Today, it's January 27 in the year 2026. The company is trading at around 42 Canadian dollars. And apparently, there are offers on the table in the low 50s. And to me, I think this is a great opportunity because at this price, still a very attractive long-term investment in my idea, in my thinking. And so the downside is protected. I'm very happy to hold this for a long time. But if we are getting taken out in, let's say, the next 6 or 9 months, then it could be a quick, let's say, 20-25% gain. I do think that at 52 Canadian dollars per share, it's still a very attractive price for a controlled buyer. Now let's talk about the company. What is MTY? It's a food franchising business. Own about 7,000 stores. Most of them are licensed in different fast food or convenient snack categories. They have about 80 different brands. And I think the way to look at this business is to look at it as a royalty business. So they own licenses to, as I said, 7,000 stores operated by mostly independent, very small business owners, and they're clipping a dividend or like a cash royalty stream. So overall, the 7,000 stores produce around 6 billion Canadian dollars in revenue total. Then MTY Food Group receives about 1.2 billion of that. And they have a really high free cash flow margin because they have no fixed cost, right? So what they get is just the royalty stream. They get money on just the franchise payments. Then there's a marketing fund and in certain services. They do own a few stores, but not too many. Overall, what are the categories? And so they have bigger brands like Thai Express, and Papa Murphy, that's a pizza chain. They do have ice cream shops, pretzel shops, and so on.
These brands, do they then basically buy these brands and try to grow them, or are some of these brands also developed in-house?
So it was basically an acquisition machine. They bought all these brands and they didn't develop them in-house. So overall, the Thank you, Sophocles, to put me back on track. It was a company founded about 20 years ago by a Hong Kong immigrant who had just one restaurant, and then he realized it's better to be a franchisor than a franchisee. It's very cash generative. So what they do is they basically, with the cash flow that they receive, they always bought more brands and stores, brands that were subscale, that maybe had like a maturity in their growth cycle. And over time, they acquired these brands. And because it's so cash generative, they were able to grow really quickly and expand the store portfolio. And when they buy brands, it's not really to develop this brand and make it big. It's mainly just to maintain the cash flow stream, make sure that the brand stays attractive enough, and again, just use the cash flow to buy more. It's a traditional kind of roll up. And when I looked at this, and I think where's the confusion is people think it's 80 different brands. Where are the synergies, and does this make sense? And then different categories, snacks, pizza, they have steak restaurants. And I think this is the wrong way to look at it. It's really about just buying cash streams and then just maintaining it and acquire more kind of cash streams faster than maybe the tail fades off. And there are certain synergies. So in terms of, for example, real estate, in certain food courts in Canada, MTY owns up to half of all the restaurants. And imagine you go into these food malls, right? So typically there's this plaza, and then you have whatever your taco place and your pizza place and your Chinese place. And MTY, they can offer this variety. And the idea is really like if you and I, we go to a food store, we want to pay whatever, 15 Canadian dollars, maybe 10 US dollars for one meal. It shouldn't be fancy, right? It shouldn't be expensive, but it should be decent quality. And then depending on our mood, maybe it's Chinese, then the next day it's a shawarma. The MTY offers this. And because they own the store, like they have access to the real estate because of the size, and they can analyze the foot traffic. This is they can play around. There's another benefit actually too. Sorry. Yeah.
So do they also then, in addition to the franchise fee, do they also then collect rent? Is that standard?
No,
or
they don't own the real estate. It's more just the access. Another mode, so to speak, is actually it's the base of the franchisees. So let's look at who are actually the operators of the store. So typically, fast food stores, these franchisees, they're first generation immigrants buying themselves a job. So imagine you come to Canada or the United States from a different country, don't speak the language really well, right? So English or French. And if you were to operate, or like if you were to start your own business, restaurants are quite easy, right? You don't need a lot of capital typically. But if you would do it on your own, you would need to get credit, which is hard. You would need to have a concept, which is hard, and another know-how, like how to renovate your store and where do you buy the material from. Now, if you go to MTY, they can help you get a location. They help you get funding because in America and Canada, you have these small business loans that are mostly government backed. So you get a very attractive bank loan that's 85% government backed. And you get access to this loan because you say, well, I'm partnering with a known franchise company, and they kind of help me get access to a good location. They help me get a kitchen and branding at good terms, a concept that works. And essentially with that, with almost no money down, immigrants can buy themselves a job, and with the job also basically their green card, right? So they are very motivated. It's 10-year contracts to keep the business afloat. And it's also from their perspective, and it's very essential to understand, a franchisee who signs up with a concept has a much higher rate of survival than people who just open up their own restaurant. And so typically, if you and I would just open a restaurant, on average, people shut down after 18 months. But if you partner up with a company like MTY, often, it goes to the next generation after 10, 20 years. But for MTY, what it means is they get a very stable base of people really highly motivated to run a good store that's attractive to the customers. and growth comes at no cost. So if a franchisee opens a new store, it's basically funded by the government, the growth, and MTY doesn't have to put money down. And it's really so right now. Yeah, sorry.
Isn't there like a risk there? Because it seems to me that, if they're just helping an immigrant basically build a business, what's the risk there for the immigrant? Because it seems like he only has upside and no downside to this.
I think it's generally just it's a win-win for a lot of people. Look, if you and I would be in this situation, would become a franchisee, right? As I said, we get access to funding, we have a concept that works, that's proven, and with that we get a salary and we get a green card, right, or an extension of our work and residence permit. And why would we destroy this opportunity? Because if we were to fail, right, first of all, it would be unlikely that we get maybe credit, and where else would we go, right? So, and I think it's a concept that really works. So what I would do, it would be like, okay, I have an opportunity, and an opportunity that is fair, and therefore I try to make it work. And if I cheat MTY, how would I cheat them, right? MTY has a lot of data points, right? And if the margins aren't good enough, everybody sees, right? And then there's more scrutiny in terms of, I think again, what is the opportunity cost? And I think it's quite high because where else would you go? And
I got to tell you a funny story. 20 years ago, funny story, about 20, 25 years ago in Cyprus, I was thinking, gosh, there's no Ben and Jerry's here. So I went out to the Ben & Jerry's website and I found all this information about franchising. But I didn't proceed, to be honest. I didn't do anything because there was this huge questionnaire and it was like, how many trucks do you have? How many other brands do you carry? And I was like, oh my God, there's no way in hell anyone's going to work with just one with me.
Yeah. By the way, I think also right now, the, early 2026 is a very polarized political environment. But I do think this is it's an interesting niche in the economy where immigrants find it quite easy to become genuinely employed, right, and keep prices affordable. So I think for society, it's a good job creation.
My parents were immigrants to Canada, actually. So that's how I was born in Canada, right? My dad worked in the restaurant business for 40 years. And I can tell you from my family and, all these immigrants, my dad, his niece had a diner, and then he had another relative who had a pizza shop. All of these people were very hardworking. All of them, very hardworking, very successful. Yeah. Very successful.
You want to make it work, right? You want to create a future for the next generation. For yourself, the next generation, you're thankful and you're working hard. And, but also coming to what are the added benefits, right? So I talked about real estate access. I talked about just concepts at work, branding. In the increasingly digital world, so there are digital sales. More and more food orders are via an app, right? So it's a menu design. It's stuff like dark kitchens, so where you have basically food orders and you have kitchens that then cater to different brands but are centralized, so higher margin. And you can only do this if you have a bigger platform. MTY is increasingly looking and investing in systems, so ERP, right, customer tracking, supply chain, sourcing sauces and chicken and so on in a centralized way.
So I did see that. I actually flipped through their annual report and I see they did mention ghost kitchens. So I was wondering, how was that with all their brands? Was that with only a couple of brands? I was wondering if that was going to be, something they can increase their margin further on.
Yeah, I think so. So, some brands are not suitable. So, a coffee shop, right? Nobody orders a coffee remotely, or let's say ice cream. But I think if you have Thai curry, shawarma, and your burger shop, then I think that makes a lot of sense, right?
Yeah, that's the one thing, like you just mentioned, that it comes to mind. You said ice cream, and actually there are there was a Cold Stone Creamery. What's it called?
Yeah,
Their
it's
ice
called some
cream
creamery,
chain.
yeah.
Yeah. So they had actually several shops actually here in Cyprus, and I think they all closed down but one, I think. So, and I did go to it. I thought it was an interesting concept. They were probably a little early to the market here, but it really failed to grow. And I think because it's very highly competitive. And the same thing with some of the other brands they have, which, are not here, but you look at them and you're like, wow, this kind of looks like a pretty competitive market, like, pizza and all the Asian foods. And like I said, I was in London last week and I thought, I went to Chinatown and I thought that was one of the cheapest lunches I had. So, I think that to me as an investor is more of a concern of there's not this one star brand, but this big portfolio. So I was just wondering how you're thinking about that. Is it that their portfolio just takes advantage of people's increasing, dining out and takeout, which has been going on, or
Yeah, no, it's so certainly. I mean, it's hyper competitive, which also explains, I guess, where the share price is trading. I mean, it was 100 Bagger was actually prominently featured in the book 100 Baggers, and then I think the environment has just become even more competitive. We had cost inflation, but sales haven't really picked up per order. We had COVID. And I think then the share price has also just lost its, or the story had lost its hype. Yeah, no, it's a very competitive industry, and arguably, I mean, some concepts like Cold Stone Creamery actually is a great example. It's ice cream, but they make it in front of you. They throw the ice cream into the air and then mix it. You could argue it's a fashion, right? And it could be like a fashion boom, and then afterwards it dies down. It's actually still going very strong, but overall you have to be very efficient, right? So you have to. I think Wetzel's Pretzels right now is very attractive, but overall, the way I look at it is, there certainly is a trend for all of us to eat out more, right? And just to pay for food that you order rather than cook at home. And what people want is they want, again, just a decent meal at a good price. And this is where where the offering comes in. And by the way, quite a few of their, so the snack category, which is higher growth and arguably more protected, it's about 40% of the portfolio. So that's pretzels. I mean, they also have coffee shops, right, and so on. And it's really like, okay, so if we had a station, if we had like an airport maybe, right, or I don't know, I'm just walking through town and I'm like, okay, I want a snack today. I would like to have Mexican food, and they're present and they can deliver a certain quality. And but I mean, to be successful, yes, it is very competitive. They certainly have the margin pressures. The stores have to look good. So in terms of pent up capex. And so for Cleese, when I did my due diligence, I actually traveled Canada and I looked at a lot of stores. And my impression is, I mean, anecdotally, but that the stores are in good shape. I mean, there's certain franchise businesses, I don't want to name any, but I think one can tell that a lot of stores are not in good shape. With MTY brands, I do generally think that actually the stores are in good shape. And you could also argue there's a protection, because if one brand kind of is not doing so well, you always have the other brands to make up.
So basically, do they force them as part of their contract or something that they have to keep up stores, or does
Yes,
MTY?
I mean, so there are two different angles, right? So MTY has a marketing fund where they can actively help, I mean, everybody, but then also franchisees where they think, well, they're suffering, but they have potential, and to make sure that certain minimum standards are met, or that, somebody gets a little push that he needs. But obviously, like if a franchisee does not deliver and they do have benchmarks, then there are contractual clauses where they can swap out the franchisee. And that's just in any franchise business. So there's, I would say, there are funds, and there's obviously an incentive for MTY to make sure that the stores have a very homogeneous feel, that they're in good shape. And My impression is that they generally are across all brands. And they can, as I said, they can help where needed. But then again, like if certain people don't deliver, then they can swap them out. They can also, what they can also do is they can say, well, if maybe a location doesn't work out because they have the experience, they can rebrand it, right? So that's another actually benefit of having multiple brands. So if in a certain location, I don't know, pizza doesn't work anymore, but Thai Express works, why not just try Thai Express? And actually to repurpose the kitchens often is not that expensive.
You said you noticed in your research. How about the consistency of the food?
My impression is that it's homogeneous and that it meets the expectation.
And there's over 80 brands, 7,000 locations. Is there one brand in particular that they're dependent on?
Yeah, so the it's with any roll up where you acquire like acquisition machines. So as you grow, your acquisitions tend to become larger, and the latest acquisition becomes the highest or the higher share of revenue. So they do have 80 brands, but the top 10 brands make up about 2/3 of system sales. And it's so what is it? So it's Cold Stone Creamery, so that's ice cream. Wetzel's Pretzels. Pretzels is Papa Murphy's, which is an interesting pizza concept. It's half-baked. Thai Express, Thai, a Village Inn, Famous Dave's, Taco Time, a Manchu Wok, and a Sweet Frog, another ice cream shop. So it's those are, I think, the key revenue contributors. And then, there's also, as you see the tail, right? I think it's always important to make sure that the tail is healthy, but not kind of also important to allocate the resources efficiently. So you really want to allocate the resources in keeping your most important brands from a revenue perspective attractive and healthy. Questions that were asked at your conference is obviously, right, have they maybe hit a growth barrier where, with growing size, it becomes harder to make acquisitions that move the needle? I don't think so. If you look at the United States, and so overall, maybe just going back, so they started in Montreal, really focused on Quebec, then conquered Canada, and eventually moved into the United States. And the United States is now making 2/3 of sales. And again, also different concepts. There is a lot of opportunity. There's no shortage in, like, let's say, fast food and snack franchise concepts. And it's really about having the capacity to acquire and the discipline to acquire at the right multiples. And because it's family run or controlled, they have a great track record, and I think they've done really well. So overall, you look at all the acquisitions. I mean, I wouldn't say that every acquisition was a home run, but overall it really worked out. And I think it's also to be fair, one has to look at the last 5 years, and it has been a terrible environment for the restaurant industry in general. So we went through COVID. I'm very impressed by how they got through COVID. Then we had high cost inflation, but at the same time, consumer pressures. So the margins got squeezed, right? Between the United States and Canada, there's the tariffs are causing a lot of just between noise and uncertainty and actually a proper impact in terms of sourcing certain commodities. Like we had these spikes, right, in prices of, let's say, coffee. But overall, I'm very impressed by how MTY got through. If you look at the cash flow, actually cash flow has consistently grown. They did have a high amount of store closures, but again, store closures and growth in like-for-like sales were never part of the story. Like-for-like sales, this was never about growing like-for-like sales or making one brand like so much bigger. It was really about maintaining the cash flow stream and growing it by making more acquisitions, and they have delivered. So the cash flow never got hit. And right now it's trading at 7 times levered free cash flow. So you're buying it at a 15% yield for a company that has consistently grown sales per share at 15 to 20% or so per annum. So what you're buying is you're buying a 15% yield, free cash flow yield on a slightly levered basis of a company that has grown cash flow per share at more than 10% per annum. It's just a cash machine, extremely capital light, with an owner kind of backing. So Stanley Ma has retired, but he's still the chairman. His son-in-law is the CEO, and so it's still family controlled. At the current price, I'm buying this at what I think is a 25% expected yield, and this is based on just free cash flow per share plus expected growth in cash flow per share. When I presented this in Cyprus, there was this talk about wouldn't this be attractive for PE? And my answer was like, yes, I would actually love to buy this completely if I had the funds. And if there would be a takeout now, as I said, it's trading today and January at 42 Canadian dollars, but apparently they have offers on the table for 52. I think at 52 it would still be a steal because any controlled buyer is likely to get a 20% levered return out of this without, I think, again, overdoing it in terms of financial engineering or betting the house. My hope would be that, so I would like to own this for longer. I almost think like, okay, if they don't get taken out, fine, I just hold it. I'm very comfortable. But if they do get taken out, I do think it's attractive for the buyers, and it still has quite a big upside from where we're trading today. I would hope for a takeout in the high 50s, maybe early 60s. And this is a great, case. And by the way, Sophocles, if there are a lot of people listening in, I think if the share price goes up, it would actually might help in the bidding war. It might help the company and those that are holding the shares get a better offer to crystallize, because nothing is more annoying to have an undervalued company where bids are on the table, but the share price is just not moving because nobody likes restaurants.
Yes.
and we're in a tough cyclical spot, but it is undervalued in
Well,
my mind for sure.
Before we talk more about the valuation, I have a couple of questions just about the company itself, just to better understand. You mentioned they're buying these companies. What sort of multiples have you seen them buy at? Because I was actually, flipping through, I saw on one of the recent conference calls, it was like they said, we're not finding anything cheap enough to buy, but I haven't done the work like you have. So historically, I mean, do you have an idea of what kind of multiples they're paying for these companies?
Yeah, it's hard to say overall because there are also synergies and so on, but they were very disciplined. And I would say it's a very different approach from them acquiring a single franchise business that is going through a tough time maybe, or there's some structural ownership changes, and somebody buying a royalty portfolio of 80 brands and 7,000 stores. But what we can do is we can look at comps, and a portfolio of 7,000 stores trading at 7 times free cash flow, and that is not expensive. I would expect at least 10 times EBITDA, and I would still actually expect this, given where we are in the cycle, and an attractive multiple.
Yeah, I mean, I looked through. I think in the annual report they mentioned acquisitions, but I didn't see any multiples. So the only thing I actually could look up was, what did they do? What happened afterwards? So, just on average, you could actually see this trend where they're acquiring stores and then the subsequent growth in free cash flow. So it seemed to me, they were increasing. What was it? I think I figured out they increased over one period that I looked at. Free cash flow went up or operating cash flow went up by 70 million, and they paid something like 700 million. So I was like, okay, so maybe they paid, this is really ballpark, obviously, 10 times cash flow. And I was like, oh, this is good because this what you're describing also is like just basically a guy buying a bunch of bonds and just clipping the coupons, and they don't really care about, you're not really interested in growing the principal. You just don't want to default. You just want to keep clipping those coupons. And I think
that's a great way to look at it. And I mean, as I said, it's super capital light. So if you look at EBITDA, what else do you have, right? You have no capex basically. You just have tax and then the interest of the holding company, and that's it. So it's highly free cash flow positive. And if you're buying a business at, let's say, 5 times EBITDA, right, that's a 20% yield before interest and tax. Taxes, you get the tax shield if you lever up. And if you can immediately redeploy this, the cash stream that you buy into more cash flow, then, that's a very attractive proposition to be in. And you can actually see this. There were these step changes where they make an acquisition, they lever up slightly, but there's this step change in free cash flow. And then they use the next 1 or 2 years to delever until they have capacity again, and then they make the next acquisition. It's a very, it's not a terribly kind of, it's actually a very simple concept, but rarely done right and consistently so. And in this case, I think it just worked, and it was very, the execution was very disciplined. It was featured in the book 100 Baggers for a reason, because, it was a 100-bagger. So somebody must have done something right, and you still have the same people running the business.
Is that where you found it? Is that where you first heard about it, in the 100 Baggers?
Yeah, so it's I read the book, and what I did is I made a short list of those cases that I liked and that where the stocks are still traded, and I put them on my watch list. And actually, then when COVID hit, MTY just sold down tremendously, but at that moment, I didn't know how COVID would play out. And I thought, okay,
End of the world.
Restaurants, okay, fine. Great to know that I was not the only one. And I didn't have the guts to buy at $5 because I was like, okay, all these shops are closed forever. And when they came out, I was surprised by just how they got out of COVID. Their cash flow never dropped. But then the share price rebounded very quickly. There might have been a lot of short covering in there, right? And then I was like, okay, too late. And but then it has come down with all the headwinds that we've seen, and I think now it just doesn't make sense where the stock is trading.
Yeah, I saw it jumped from something like 15 just from looking at your presentation. Actually, now it's I see you have it here. It's went from 15 to about 55, something like that, within a very short period of time. That would have been a nice, a nice 5.
And you could actually have done this a couple of times in the last 5 years, right? So this is one of the things where, in hindsight, if you had bought here and you could have easily had a max or so in a few years. But anyways.
So I was looking actually also in there. I was looking at the 24 accounts, and I saw they also did the segmentation with, revenues and operating expenses for the franchise, corporate stores, food processing, distribution, retail. I'm not quite sure what that category is. Maybe you can tell us. And it seemed to me that, franchise had the highest operating margin by far, when corporate stores being the least. So I was thinking, why don't they just get rid of all the corporate stores and just go only franchise? I don't know if you can, have any comment about.
So most of the shops are franchised, but they do own some stores. Meaning, so the employees on the payroll. That's right now 250 stores are owned out of 7,000 locations. Now, why do they actually own some stores? And this is really to, sometimes when a franchisee gets into trouble or when they think he's not doing a good job, they actually take control and then improve the quality and so on. And the margins are lower, but it's more of a portfolio. Let's put it, this is the part of the portfolio that requires some active involvement. And why are they not shutting it down? Because they take the stores onto their own balance sheet if they still believe that there's potential. So for example, the last big acquisitions they made was Papa Murphy. This is a funny concept. So what is it? So it's basically half-baked pizza. So you order a pizza, almost like a restaurant, and actually you put together all your toppings. You go to pick it up, and so it's freshly made with fresh ingredients based on how you like it. And then you drive home and you bake it. So it's a mix between a fresh pizza bought in a restaurant and something, a frozen pizza. Initially, like for me, I'm European. Actually, for us, it's very okay to have frozen pizzas, and they're dirt cheap. In America, people are, they always go to a restaurant, they go whatever. So I had to get my head around it. Like, why would you pick up a freshly made pizza, but then still kind of bake it at home? But it's because people like the freshness and the customization, right? So like special topics and so on. And it does taste a lot better than just a frozen pizza. And the price point is somewhere in between a frozen and a restaurant pizza. So, but some stores just didn't work out post acquisition. Maybe it was because there was a bit of a fad, but the pizza market is also very competitive. So maybe it was just the environment. And they decided to take a lot of those stores onto their own balance sheet because, as I said, they think that with CapEx and just more thorough kind of operational scrutiny, they can actually make those stores work again. And maybe it also comes back to, you acquire a portfolio, and then after that, you just weed out those stores that don't work and make them work. It's maybe one of these just processes that are common in this business model.
And because you've mentioned, what do you have for free cash flow for the company, just so I can better understand?
Yeah, so in Canadian dollars, on an LTM basis, I have about 140 million in owner earnings. So I have 180 million in operating cash flow. I make an adjustment for working capital that's just driven basically by the own stores, leases, right? And then CapEx. So CapEx is low. There's some maintenance CapEx, mostly on the shared central services. And then I get to owner earnings of 140. The distribution yield for me, that's about 70 million. They did repurchase 40 million shares and they paid 30 million dividends. It's interesting to note also that recently they increased and the rest, so 140, right, free cash flow, operating owner earnings minus 17 distributions. The rest was used to delever. So they increased the capacity to make potential acquisitions. It's interesting to note that in the last 2 years, they started buying back for the first time in size. And they did say that at the current multiple, again, it's trading at 7 times market cap to owner earnings, free cash flow. And they do think that buying back their own shares is a highly attractive opportunity, more so than maybe acquiring new stores. But they're also delevered, which gives capacity for. So on the one hand, de-risks the case and offers opportunity to acquire again. They haven't made an acquisition in a year as they were adjusting the last large acquisitions they made just kind of during COVID or just after COVID. So people buying into this now get a distribution yield of 7%. It's a mix of cash dividends and buybacks. But they're getting a 7-time free cash flow yield.
So you're saying it's about free cash flow is 140 million.
Yes.
Because there's no dividends to JVs because what you mentioned. So it's basically operating cash flow minus leases minus CapEx. So for me, that's So and you're comparing that to market cap. Is that where you're getting your?
Yes. So the market cap of around at 43 Canadian dollars. It's about $1 billion Canadian dollars.
And that comes out to something like 14%. But there's also, if we were to do this, compare the 140 to EV to enterprise value, what do you have for enterprise value?
So the enterprise value is 1.6 billion Canadian dollars.
1.6. Oh. So basically, because I also saw this, I noticed this in just through the company docs. It's like the market misunderstands the company because they're not offsetting the finance lease receivable. So the EV stated on some financial websites is higher than it should be.
Yeah, correct. So ever since the change in accounting standards where leases get kind of activated, right? So a lot of the screening tools don't work. Even I have to, when I go through Capital IQ, sometimes I get really annoyed because I have to adjust the leases. What I do, and I think it's the right approach, is for me, leases are, I don't include them in net debt. because in this, but what I do is obviously I do offset the lease component running through, depending on how they account for it in the finance cash flow or investing cash flow to adjust the free cash flow. So what we had is, with the change in accounting standard, we had an uplift in EBITDA. And one has to be careful to actually look for how leases are running through the cash flow statement and then adjust for this to actually bring the free cash flow down again. But on the other hand, I think it's not real debt because, depending on the rental contracts, the lease contracts, they could probably close the stores or repurpose the stores, and it's not recourse debt in a lot of cases. And so is it recourse? Is it not recourse? Could you get out of those contracts or not?
No, yeah. I mean, that's the way I do it myself as well. I do it. I do a DCF where I'm just like taking out, making an assumption for the lease payments, and then I don't include it in the final thing. And so there are something like 500 million roughly in at least. You take that off, then you get to, like you said, the 1.6. So it's 140 million free cash flow compared to roughly 1 billion market cap, or 1.6 for those of you listening and trying to figure out the multiple.
And then the thing is about obviously the EV, right? Yes, there is that. The question is, how risky is this, right? And what does it mean? And argue because we are buying a portfolio of a very capital light business, it's okay to lever against it, right? And I would also, you have, and again, here comes back like the underlying also risk is partly government funded, right? And so on. And I think it's a very attractive proposition for banks to provide senior debt against or to. So I think it's okay to lever it to a certain extent. So I think there's a healthy margin of safety. And then going back, so on a levered basis, so for please, as you said, people are getting a 14% free cash flow yield, currently a 7% distribution yield. And historically, earnings growth per share was 17% per annum. And so if you are thinking, okay, so you're getting a 15% yield, 14, 15% if you just hold it. And on top of that, historically, you got 17% in earnings growth per share. That's a very attractive underwritten return. And even if the assumption is that the business model is not as scalable anymore as it used to be, which I think it's not my assumption, it's still easy to get to an underwritten return of 20% or so free cash flow, like growth plus a free cash flow at the current rate without betting the house. And actually, I think that's conservative.
I mean, how do and I can definitely see how this doesn't screen well. Someone if just looks like at a couple of numbers, it probably, they're probably thinking it's got like over 4 times debt to EBITDA, just looking at the raw numbers. So they might like just, immediately discard it. And plus, the whole, a bunch of brands versus one big brand, which people know. That's probably also another thing which people don't like. So how does this compare though to, like, what are the comps here? What comps are you using, and how are they trading at? Are they trading at a similar multiple, or is MTY at a discount to their comps?
Yeah, here I would answer like I hate comps. Maybe I got burned in the past. For me, I think actually for me, a comp would be a commodity streaming business. I think it's completely I think the misconception is that this is a restaurant business.
Yes.
Because it's not. It's a royalty streaming business. And people are buying a portfolio. It's almost like you have this PE fund or this holding company. And so for me, actually, a comp would more be as I said, a commodity streaming business. Obviously, you're not levered on the commodity price. And I just look at the cash flow the stream that you buy and what you pay for it, and what is the downside protection here. And I think it's sufficient. And so for Gliss, you said it doesn't screen well, or you can see how it doesn't screen well. I fully agree for the reasons that you mentioned. I would also say there are just these structural market dynamics in the cap table where certain sectors are completely ignored by the capital markets these days for structural reasons. And this is providing great opportunities for the likes of you and me and the community Sophocles said, you're fostering. In my mind, the world is driven by passive capital, which initially made sense, but now passive capital has become a price setter in its own right. And if you look at the indices, which are driving capital flows, it's mostly the United States, it's mostly tech, right? And here you have a company, it's not in the index, it's in a sector that's currently not on vogue, it's hated, it's restaurants. And the cap table shows, so we have the founder, Stanley Ma, on 13%. You have Fidelity in there is 9%, and the rest is, I guess, retail and small funds like me. So there is no institutional capital looking at this because the company currently does not attract these structural passive capital flows, and it's not in a sector that's benefiting from the momentum, right? Actually, I would say it's this opposite momentum. It's this momentum trade where currently the momentum is against this company, but it could also swing back, right? Or where I think we have a structural inefficiency in general that is providing a lot of attractive opportunities for smaller investors that are actually doing the work and still looking at fundamental data and business models. And,
You're a dinosaur.
I'm a dinosaur. And, Sophocles, when I go to your conference, I'm in Cyprus, right? And we're with this tight-knit community of what I think are very thoughtful, very intelligent value investors, very successful also, right? But all the companies that we talk about are not necessarily the companies that, you would talk about at a cocktail party. And what I often think is like, so I go to Cyprus and I see these incredibly intelligent people, much more so than I am. And they're very successful, but their investments are very different from the mainstream market. And when I look at the mainstream market, I'm very kind of concerned because like, what if, these capital flows suddenly reverse, right? Because valuations in my mind are not cheap, at least not in the traditional sense. Now, can these structural trends go on for longer? Yes, of course. I don't see passive capital going away anytime soon. But at the same time, there is a structural opportunity where people can buy very attractive businesses at very attractive terms. So for anybody who wants to have a portfolio of away from the mainstream markets, this is an opportunity. And I think this is also why this company is up for sale or why it's attracting buyers. So now, why is the company up for sale? So the founder, Stanley Ma, he's retired, he's older. I think he's in the 70s. Apparently he has health issues. His son-in-law is running this. I think he's doing a great job. As somebody pointed out, he's objectively underpaid. So I would, if this would be if I would be the buyer of the whole company, I would certainly keep Eric on the payroll because I think he's doing generally a great job. I might make him more incentivized, not just to the family, but directly into the economics. But I think it's a business that has done tremendously well. The founders, he's retired. If he has health issues, right? They went from this amazing run to now a tough 10 years, having gone through COVID and so on. And I think there's a certain fatigue and a realization, why don't we just sell out? And as I said, it does not mean maybe the end for Eric in his position. I think he's doing a great job. He's a great guy. I would buy this at 52. And again, it just shows that there are pockets in the markets where you have overlooked, ignored businesses. And it's classic, old school, intelligent investing. And when I went to Cyprus, I never went. Anyways, your community has quite a few of those stock pickers and those ideas where, it's great.
So just going back to a few points you said. Like one, you said you'd buy it at 52, even though it's 40 now. So what do you think this is worth? We'll just start there. I have a couple more things based on what you said. Or you don't have like a specific number. It's more that you're interested in holding what seems to me to you to be a compounder.
under the assumption that the cash flow just stays continues its historical path, even at the current multiples. As I said, you're buying what I would buy a free cash flow yield of 25%, maybe 30, right? Just like expected growth in earnings per share, and plus the valuation discount on top. And I would, under the assumption that I'm very comfortable with the cash flow stream, I think even a 15% free cash flow, like underwritten return on a slightly levered basis would be okay. So that would be a double from today's price. So I think at a double, 14 times free cash flow plus some growth in earnings per share. So then 7% free cash flow plus some earnings per share, right? Still gets you to, 14, 15%. And I think that's attractive. And there will be bumps along the road for sure. And look, it could change so quickly. Also, the perception, right? If they just make one more acquisition tomorrow, where cash flow jumps another 50%, then it screens much better, right? And so I think there's just one good acquisition. They could significantly just improve the screening because of the jump in cash flow. If there would be just a small change in perception about the restaurant industry, the portfolio, if they go to net store additions versus having gone through a period of net store closures, if the perception about the North American and Canadian consumer changes. And here's another actually way I look at it. So historically, restaurant businesses have done a great job in passing on inflation, but there's often a lag. And when I would argue that we have gone through a period where restaurants in this segment, ice cream, they went through cost hit, but they haven't really seen the revenue benefit from inflation, but this might come. And Sophocles, I remember a time when a scoop of ice cream cost literally 10 cents. And now, I'm paying $3 and that is insane, but it just shows you that, have I reduced my consumption of ice cream? No, right? There might be times when Ben & Jerry's is too expensive and I go to the no-name ice cream, but I think, again, snack category, right? People are willing to pay for convenience. And actually, one of the mistakes I made is not to buy Starbucks in 2008 in the great financial crisis. So here I was, right, freeing about my own job in 2008, seeing the world collapse around me. I was living in London at the time. All these bankers were being fired. And I'm thinking, do I really want to pay $6 for a coffee that I can make my home for free, basically, right? And Starbucks is trading at 5 times cash flow. And turns out that, it's a small luxury and people still paid for their $6 lattes. And they still are. Is there competition? Yes, competition is ruthless. It's very tough. But, as long as you can compete and offer products that offer a sufficient quality. And as I said, over time, it's a great way to bet on inflation. So, people can buy gold, they can buy Bitcoin, but buying into industries where you almost have a royalty on sips and bytes is not a bad way. And And looking at Warren Buffett, Warren Buffett, he went levered long, McDonald's and Coca-Cola, and he did say Coca-Cola's royalty on sips at a time where inflation was in the States was 20%, and Coca-Cola was just, starting to get a bigger pie of the world consumer. And this company is obviously not a Coca-Cola McDonald's, but it is very capital light. It's trading at a low multiple, and people are buying a royalty on people's daily menu.
I understand it. Now, looking at, so this is basically essentially a family business, what is what you're saying, and they're kind of tired, I guess, and that's the reason, they're considering selling. So it doesn't have anything to do with anything being wrong with the business. That's what I'm getting from you. And please correct me. So I don't know if you have any other additional points down, just looking at the board or the management or anything else, it seems that, you're very happy with the CEO, and the owner seems to be a genuine guy who's built this empire. So if you have any other comments on them, I'd like to hear. And then could you tell us something about the PE? I mean, have you looked at all of these firms? Is this like their typical type of acquisition? Do you sign this as a decent probability?
Look, on the management, I am very happy. Now, when I presented this case and in some follow-up conversations, there were questions about their recent acquisitions, right, and so on. But I think people forget how tough the last 5 years were in the restaurant industry. And it's always easy to judge, but very hard to do. And in my mind, they haven't done anything that didn't make sense. So on the contrary, and I think they're also going through the step change where, they're now consolidating the base and really building the backbone to service these brands. So I'm very happy. There's no question about alignment and skill. And I think they've done a great job navigating the financial crisis. And I do think that the potential sale is really triggered by, again, age, health, and just fatigue. Now, in terms of the buyer, I'm not going to comment on the rumored names. What I would say, given the price, it's probably good enough that what's on the table. But I would not exclude the probability of the family saying, well, it's not good enough, and we'll just wait a couple of years and see whether we get a better price. As always, with merger arbitrage, there's no guarantee that something goes through and at what price. And so there's no guarantee that low 50s, high 50s will get realized. What I would say is I can see why it's attractive for PE and also maybe family already in that space. PE gets a decent portfolio at an attractive price, and they do get a good operator. I think what makes this case attractive for PE is that with Eric, the CEO, they do get skill and alignment. As I said, I can totally see how Eric will stay on and not just in a kind of fake advisory role, but actually hands-on with incentives, because there's nothing wrong with the business. In terms of financial engineering, you can't do much because they're already levered. They delevered, so you can lever up a bit. But I think it's really, you just buy the current yield and you do get a good operator, and you want to make sure that the operator stays. Now, if a family would bid for this, bringing in already expertise and portfolio, makes a ton of sense, because they maybe buy better systems, they already would bring in their own experience, and they might want to. But then it's probably a question of, do they get funding or not? Overall, it's an easy buy for financial investors and strategic investors.
I can see there's a lot of people who do agree with you, because I saw volume popped in a big way a few days ago. So there's people who are agreeing with you, or they're trying to do some merger arbitrage on that.
So the company, so the last times I reported quarterly earnings, right? It's I guess revenue was somewhat underwhelming, but not terrible. Cash flow is actually holding up really well. Then the share price just took a dive. I don't know whether it was driven by short interest. They came out with a press release basically saying, well, they're doing a strategic review, putting the business potentially up for sale. Share price didn't really move. It went up and went down. We saw a small pop, but again, what I think is insane is a company, in my mind, if I'm right, a company that looks fundamentally undervalued, and that apparently has 2 bids on the table, which seem credible bids at a higher price, that the share price did move more. So again, there could be just short covering, maybe a few people betting on the takeout, but it's not. I would expect it to trade much higher. I'm a very happy holder at the current levels, and I wouldn't mind buying more actually, because why not, right? So what is the worst case? The worst case is that they come out with terrible results showing that, yes, actually the environment is much tougher than we think, and the stores are suffering, and therefore the sale falls through. and then your some hot kind of money that went into the stock maybe leaves, right? And then so in addition of the potential takeout going out of the story, you know there's more uncertainty about just the business overall, plus then forced selling or fear-driven selling. But yeah, I mean, again, then I think what it would require is just being comfortable in the story, being comfortable like long term, being comfortable that management will use the current environment to actually increase the value of the business. Because if MTY has issues, I'm sure that a lot of other businesses also have issues. And then, you know, there's again opportunity for acquisitions and all of this. And then being willing to stomach through the drawdown and just the share price hit and waiting for another catalyst down the road.
Okay, great. Really interesting. So, okay, I think we've covered most of the bases on this. So unless you have anything to add, you can let us know. Like if people want to reach out to you, do they do so on Twitter, LinkedIn, someplace else?
Yeah, sure.
Or...
People can reach out anytime. I'm always happy to answer questions, be corrected when I'm wrong. I don't expect this case to last, like to age well, so to speak. Hopefully, like in a few months' time, we're sitting here. It's like, okay, handshake. And if not, we'll do another podcast in a year's time, talking about why it's still worth 50, even though it's trading at 20. So thank you for your time and all the work that you put into your community.
Thank you. You're way too kind, Robert. I'll see you next week in Switzerland. I'll put a link in the notes to Robert's fund and LinkedIn, so you can reach out to him at either of those places. So MTY Food Group, let me know what you guys think. Definitely interesting, especially now with the bids on the table, looking at probably like $10 higher from here. So that would be a quick 20%. So Robert, thank you so much. Thank you, and I'll see you soon.
The podcast episodes should not be copied, distributed, published, or reproduced in whole or in part without the prior written consent of the host. These recordings are for informational purposes only. This recording does not address all risks. The podcast is not intended to be relied upon as a forecast, research, or investment advice, and are not a recommendation, offer, or solicitation to buy or sell any securities or to adopt any investment strategy. The views and opinions of any podcast participants are subject to change and are not necessarily those of any companies affiliated or associated with the participants. The participants cannot guarantee the accuracy of the information in this podcast and has not independently verified the accuracy or completeness of such information or the assumptions on which such information is based. There is no guarantee that any forward-looking information will come to pass. Reliance upon information on this podcast is at the sole discretion of the reader and or listener. Past performance is not indicative of current or future results. This podcast is being made available for educational purposes only and should not be used for any other purpose.